Thanks very much, Johnny. Big tech has committed hundreds of billions of dollars to AI, fueling this debate over whether markets are witnessing a bubble or a fundamental shift in the global economy. Joining us today is Dr. Ryan Lamond, founder and CEO of NeoVision Group. We'll examine where AI is delivering real value for wealth managers, compare the differing AI strategies of the US and China, and assess the risks to energy markets if the US-Iran conflict is not imminently resolved. Ryan, welcome to Wall Street to MENA.
Thank you for having me, Rachel.
So, big tech has poured hundreds of billions into AI infrastructure. Some strategists call this bubble territory. Others say the AI trade still has room to run. Do you think we're in a genuine bubble, or is this a structural repricing of the economy?
Well, having lived the year 2000 internet bubble, I can 100% confirm that we are in bubble today. From a valuation perspective, I don't think there are two analysts who disagree that we are in overvaluation territory from a ratios perspective. The second thing is we evaluate bubbles is when companies are overvalued with no clear path towards profitability. And let me give you a couple of small examples. Um, I currently have a subscription where I pay $200 each month for my AI provider, and I actually consume each month roughly $5,000 of tokens. Since the beginning of this year, I've consumed 1.3 billion tokens. So this difference between what I pay $200 each month and what I consume in tokens, which is $5,000, this difference of $4,800 each month is being financed by VCs and what we call hyperscalers like Microsoft, Alphabet, and others. And this is unsustainable as long as these AI companies cannot charge me $5,000 each month or lower the cost per token that I'm consuming. And this is not very close to happening. We are still in the first generation of this technology. Just like year 2000, we were generation one, and most of these companies are gone, and we evolved into more profitable, more efficient companies.
You know, that's interesting, Ryan, and I want to pick up on a few of the things you mentioned about like the energy that's required to run it and this intersection between energy and AI. But before that, you have been using machine learning for portfolio optimization and NLP for client engagement. So in your view, where is AI then genuinely changing how wealth managers allocate capital versus just adding hype to pitch decks?
It's basically the speed and access to information today is a whole quantum leap compared to what we had before. So when you received a complex inquiry from a client, we had to have the analyst work on it, produce a note, and then send it. Today, this is almost instantaneous thanks to AI. However, we still need that analyst. So all of this talk about job destruction is completely incorrect, in my opinion. And it's very similar to 100 years ago when we had the Industrial Revolution. When we had factories starting to use machines, everyone said initially that there will be job destruction, but actually the reverse happened. There was job growth because to operate that machine, you need the specialists who used to produce that product manually to use that machine and optimize it. And it's exactly the same way. The analyst that we have today has to upgrade his or her skills to use AI to produce information and analysis to clients. So the big difference is the speed and access to information that is today completely different from what we had before 2023.
And you mentioned a good point there, Ryan, about like the production that aspect when it comes to AI. And I want to look at the two superpowers in this space. You have the US and you have China. How are their approaches differing? And what do you think could be some downstream implications of this?
So there's a whole big difference between the US's approach and China's approach. Let me give you a few examples, a few numbers actually. In the United States today, the number of data centers is 5,500 data centers. There are 20 to 30% that is not yet operational because there's no energy to supply these data centers. So the US has adopted the approach, or US companies have adopted the approach of centralized data access through these data centers. Now, there are multiple problems to that. The first problem is access to energy. These data centers are very, very energy hungry. And second, it's technology rollover. So every 6 months, we have a new chip that comes out. So these massive data centers have to upgrade their chips relatively regularly. China's approach is completely different. China's approach is not LLM, it's more SLM, small language model. So if you look at the number of data centers in China, it's just 500 data centers. So they're focusing on a decentralized approach towards the problem, whereby each unit has his own or her own mini data center based on a small language model. Second, China has worked on energy. If you look at gigawatts energy production by China, it's literally going vertically up. So energy expansion in China is much, much, much higher than anything we have seen in the history of the world. Whereas in the US, it's basically horizontal, it's stagnant. There's isn't energy production is not really increasing. So this gives you a small insight on who might be successful in the future. The last thing is if you look at the hyperscalers like Microsoft that invested heavily in OpenAI, today, Microsoft is switching to Chinese models for many, many reasons, one of which is it's less expensive, less energy hungry, and more accessible, and not reliant on this technological rollover that you have to do every 6 months. So even the US companies are starting to switch to true Chinese AI models. Which one is going to win? I think it's not yet over. The medium term will show us which country will prevail and which model will prevail.
Well, let's dive a bit deeper into the numbers there that you mentioned, Ryan. You said 5,500 data centers all struggling at the moment, or many of them struggling to get the energy requirements. As the US-Iran conflict rambles on, and given that roughly a fifth of global oil supply translates through the Strait of Hormuz, what's your base case? And I guess there's two ways to approach this. If the US-Iran ceasefire talks collapse again, what could be some impacts on the AI industry and also just the oil markets more broadly?
Well, the impact is mainly on pricing. Today, energy prices, refined products is very, very high. Even when we have the detente that happened a few weeks back and oil prices dropped like a rock, refined products were still at pricing at almost an oil of $100. Here in Paris, where I am, many of the cars are struggling to find diesel to fill up their cars inside of Paris. You have to go 20 or 30 kilometers outside of Paris to fill up your car with diesel. So this impacts basically energy centers because they are price sensitive to electricity. So the higher electricity prices are, the higher the price per token will be. So instead of $5,000 per month in my case, it would be $6,000, $7,000. So this has a direct impact on energy consumption of these massive data centers in the United States. Now, the United States refines its own oil, so it's independent from that perspective. Many other countries, like in Europe, they will be very sensitive to that. Um, um, uh, so another point is helium. Now, helium is essential to manufacturing chips. It's one of the basic components of manufacturing these famous chips that NVIDIA and many other companies manufacture. Today, refined products with gas being blocked through the Strait of Hormuz, mainly from Qatar and other GCC countries, accessibility to helium is much more difficult and much more expensive. So this will also impact the infrastructure costs of manufacturing these chips that go into these massive data centers and the PCs that we use every day. So the pricing of hardware is going up because of the Strait of Hormuz, which is a direct impact as well.
Thank you so much, Ryan. And closing question from my side then. So obviously this energy shock has a large impact on the AI industry. When do you think we'll actually start to comprehend the real impact of this? Like if the strait reopens immediately and, kumbaya, we all have a truce, is it going to be, has the impact already happened?
Well, the energy shock has happened. It's over, and it will feed into inflation over the medium term. If we look at the second largest energy shock in history, which was in 1970, the 1970s, back then it impacted 6 to 7% of international oil exports. Today, it's impacting 21% of energy exports from the GCC or world exports. So this gives you a sense of how heavy this energy shock we're going through compared to the 1970s. We tend to think that it will resolve itself very quickly, but when we look at reality and logistics experts, if the Strait of Hormuz is open today fully, it will take roughly 3 months for traffic to normalize. Second, you have many of the refineries in the GCC that are shut down that will take also another 3 months to fully operate again. You have the refineries in China, in Russia, sorry, which is the second largest refiner in the world, many of which have been destroyed with the Ukraine-Russia war. So the problem is not export of oil only, but also refining oil and getting these refined products like gasoline, like helium, like diesel, etc., which will take months to come back. So this gives you a sense of the impact on inflation. And this is why, if you look at the treasury rates today, they are above 5% for the longer maturities, whereby the bond vigilantes are telling the Fed and other central banks around the world, you are mistaken to freeze rates. You have to increase rates. So we are heading towards an inflationary environment and a rising interest rate environment.
Dr. Ryan, thank you so much for joining us today. Your macro views are always just so spot on, and it's a really good summary of the market and what's going on. So thank you so much for joining us today.
Thank you, Rachel.